Well, thank you, Felipe. Can we switch us slides, please? Okay, good morning. This is joint work with Emmanuel Farhi at Harvard, and it's an investigation of shadow banking. There are various views on shadow banking. One is that shadow banking is some kind of breathing space because regulators don't have a clue and they impose unnecessary regulations. Some of that may happen, for example, in China, where there are a bunch of regulation preventing banks from lending to SMEs, for example, small and medium enterprises, because there is a lot of pressure to lend to SOEs, state-owned enterprises, or there is financial repression as well. So there's a natural migration to shadow banking. At the same time, shadow banking can be dangerous, and lots of papers are about shadow banking being a nuisance. Basically, some capital evasion by shadow banks. Basically, they have access to public liquidity, as we have seen in 2008. They should not have access to public liquidity, but they do. At the same time, they are not regulated at all, so they don't face capital adequacy requirements and all those constraints. It could also be capital adequacy requirements evasion by retail banks, as we have seen in 2008, because we had all those retail banks building conduits. I mean, when they securitize, they build conduits, and they were giving lines of credit to those conduits, and that reduced the capital adequacy requirement a lot, even so there was no real risk transfer. So and there are other series of shadow banking. Some have to do with neglected risk, some have to do with competitive advantage. But what we are doing with Emmanuel is really something very normative in a sense, and we go back to asking what is financial intermediation about and what should governments do about it. And that creates some questioning about what shadow banking is about and its role. So let me just go fast through it. The first puzzle, there are really two parts in the paper. The first puzzle is addressing what we call the quadrilogy. If you learn about banking like 30 years ago, you'll learn that there are really four pillars on banking. One is lending to small and medium enterprises, dealing with retail depositors, and by the way, you have access to deposit insurance. You also have access to lender of last resort function, and you are supervised. So it was a kind of coincidence between four different things. In contrast, shadow banks are not supposed to lend to small depositors. They are not supposed to have access to deposit insurance and not have access to any lender of last resort function. The standard definition of shadow banks, there are some divergence about what the exact definition is, but basically it's transformation, so some kind of banking activity that takes place without direct and explicit access to public sources of liquidity or credit backstops. And in countries like Europe, we have a directive says there should not be any bailouts of shadow banks, but it's all over the world the case, of course, that people are against bailing out shadow banks. Now, it's not obvious why you have this coincidence between those four features. After all, the government or the state could offer lender of last resort or deposit insurance to shadow banks and price that. There is no reason why you could not offer deposit insurance and lender of last resort function to shadow banks. There's always a price that you can charge for that. The other puzzle, of course, is that in fact, we have observed that banks actually do gain access to public liquidity. Indirectly, through siphoning off the public liquidity, so that's what we had with a contingent line of credit and all kinds of things. Basically, retail banks supplying liquidity to shadow banks. And then directly through bailouts. So, we have seen many in 2008, we have seen many facilities were actually meant to rescue shadow banks, and including investment banks and money market mutual funds, and so on and so forth. So on the one hand, the theory doesn't correspond to the practice. So the theory is that shadow banks should not have access to any public liquidity. And on the other hand, there is this kind of puzzle about why the state could not actually price lending of last resort and deposit insurance to shadow banks. So that's the kind of puzzle we address in the paper. And I want to talk a little bit about the client side of the puzzle. There are those, two of the components of traditional banking refer to fragile and politically sensitive clients. The retail depositors, you and me, and the small and medium enterprises that borrow from banks and all liquidity there. And again, that should not be taken for granted. And as I mentioned earlier, there's been some migration in China. And by the way, it's all over the place. I don't know about Latin America, but in Europe and the US, shadow banking is growing fast, including in those segments, which is kind of new, right? So the second part of the paper is really trying to address structural reforms. Actually, I mentioned 4 features of traditional banking, and I will add 2, and it might be a bit controversial, but if you think about recent reforms, they include structural reforms. Volcker, Liikanen, and in the UK, John Vickers' role, which has to do with creating a ring-fence subsidiary, trying to cut the retail banking from the influence, the bad influence of shadow banks that might go bankrupt. So basically, you have limited scope of activities for ring-fence subsidiaries, the retail banks, which, by the way, won't prevent them from taking risk. I mean, it's another thing, but at least trying to prohibit them from providing support to the investment bank. So basically, you don't want the retail banks to help the investment bank. The other way around is fine. The other big evolution, I mean, there have been many evolutions in Basel III. The other ones are not Basel III, but they are concomitant, was moving contracts to exchanges. So basically trying to reduce the importance of over-the-counter markets, which did so much damage in 2008. And if you think about it, it's just information economics. It's very hard for a regulator to understand all those contracts. They are extremely detailed. That makes regulation very difficult. You don't know what the exposures, the real exposures are. And there's been a trend toward incentivizing retail banks to use exchanges as opposed to over-the-counter markets. And that's one of the things that we want to address as well. Okay, now take-home points in case Gabriela shows up. So you at least know what the paper does. First, we provide a normative explanation for this quadrilogy. So we argue there are basic complementarities between regulation and the 3 other components. And it's a very, very simple argument. Basically, what we argue is that if you regulate banks, you are going to reduce risk. I mean, that's our assumption. Which is a reasonable assumption. Regulation is monitoring risk, and therefore you can reduce risk by regulating. But then that reduces the cost of providing insurance. Because if you think about lender of last resort, it's insuring the banks. If you think about deposit insurance, it's insuring the regulator. And you have to ask, what is the cost of this insurance? It's costly for the state to provide insurance. You have to basically pay money when things go wrong, and probably it's a state of nature where actually the shadow cost of public funds is high. And therefore, if you monitor, if you regulate, you reduce the cost of providing this insurance. And therefore, there's a complementarity between regulation and lender of last resort and deposit insurance. Now, it's all going to be driven by another thing. And part of it is driven by another thing, is that you cannot refrain from bailing out banks if those banks are lending to SMEs and are taking deposits from small depositors. So there will be a time consistency thing in the model that you're going to see. But then we also argue that ring fencing and the use of exchanges is actually a good thing as well in this framework. So I'm going to go through that. So here's the model. So the model is a simple model in which there are liquidity issues. So you need at least 3 periods. So standard model 0, 1, 2, and there is one good, no store value, just to simplify, and 3 classes of players. So the consumer investors in the first step are just completely risk neutral. So there won't be deposit insurance for the moment. We'll add deposit insurance later on. They cannot pledge their future income, and there is no need for deposit insurance. Bankers, it's a standard model of banking with a liquidity shock. Okay, there is nothing new there. The bankers invest at date 0, so each banker invests 1. And then there is more hazard, and that's where regulation is going to come in, because you can engage in more hazard, and that's going to increase risk. Okay. Then there is a liquidity shock. So it's a standard way of formalizing the liquidity shock that you may need 1 more to continue. So you have invested 1, and you may need 1 more to continue, or you may not. Okay. So there will be a probability P that there's a liquidity shock and you'll need 1 more to continue. Now, if you don't continue and you don't pay this amount 1, then you are going to stop and there won't be any payoff. Whereas if you continue, so you're able to pay 1 in case you face a liquidity shock, then you go until day 2, and until day 2 there will be some pledgeable income and some non-pledgeable income. Again, it's a standard way of formalizing things in which not all income is pledgeable to investors, because otherwise we know there will not be any liquidity issue because you could just dilute those investors. And that will be the Aude-Breu model, and there will be no liquidity issue. Okay, so the way we formalize that is that there is some pledgeable income, rho 0, which is less than 1, because if it were greater than 1, then you could just dilute existing claim holders and basically finance a liquidity shock. And there is a pride benefit for the bankers, B. Actually, we basically take the banker's utility very simple, as being very simple, so it's date 0 consumption, C0, and then they want to continue, basically, and if they continue, they get their pride benefit B, okay? So their utility is the expectation of C0 plus Bj, J where J is equal to 1 if they continue. Okay, so here the continuation rents come from a pride benefit. There is no incentive compensation, but you could do it the other way if you want. Now this is the important slide which explains the stochastic structure. So for the moment there will be only aggregate shocks. So let me just tell you why we do that. Later on, we will be talking about cross-exposure. If you want to talk about cross-exposure and therefore be able to talk about ring fencing, about exchanges and the like, or OTC market, you really need to have some imperfect correlation. But let me simplify for the moment, and let's assume that you have perfect correlation. And there will be a double shock. One is on the fiscal state. So the fiscal state is going with priority P, it's going to be bad, and with priority 1 is going to be good. So good means that the shadow cost of public funds is lambda, small lambda, greater than 1, and bad means it's capital lambda, it's big. Okay, so basically. There is a parameter which indexes how costly it is for the state to rescue banks. Now it's going to be a monetary cost, but you could also think of that as being a political cost. So how much does it cost politically to the state to rescue banks? Is that unpopular or very unpopular? Okay, but think of that as just being a money cost. Okay, so with priority P, there is, and the reason why we want to introduce that is to create some uncertainty for banks about whether they're going to be rescued or not. If they were always rescued, then they will never accept any lender of last resort function because they know that they will be rescued anyway, so that's not an issue. So actually we choose parameters so that in the state small lambda, there will be a bailout, even if it's in the shadow banking sector, but in the state capital lender, it's so expensive to rescue the shadow bank that you're not going to rescue a shadow bank, and that's where lender of last resort is going to intervene, because it will be some kind of insurance contract. So that's the first aggregate shock, which is a fiscal state. And then there's a liquidity state shock, which is also aggregate. So later on, we'll make it imperfectly correlated to allow for some insurance across banks and cross exposures, but for the moment, it's the same shock for everyone. So with priority pi h, everything goes fine. There is no liquidity need, so you don't need any money to continue. With priority pi l, then you need reinvestment need 1, and all the banks face the same shock. Now, moral hazard really means that you reduce the probability of no liquidity needs. So you can shirk, and there could be a small pride benefit for that, whatever. And delta, so you reduce by delta in the good state and by delta prime in the bad state. Moral hazard is multidimensional. It's just slightly simpler to do it this way. So you can choose to reduce the probability of a shock as a function of the fiscal state. Okay? But the important thing is that you have perfect correlation among bankers, so for the moment there is absolutely no scope for cross-exposure. Okay? So then we introduce monitoring. So M equals 1 means that there is monitoring, and when you monitor, you can prevent, basically, you can prevent this moral hazard. You cannot shirk anymore, okay? So because you are being monitored, okay? So, but there's a cost to monitoring. The cost to monitoring is called C. And for the moment, by the way, we don't, the monitoring, think of the monitoring being done by the government, but it could also be done by a private sector. And we impose a condition which is going to imply that actually in shadow banking, there won't be any monitoring, including by the private sector. An important ingredient is the preferences of the social planner. So it's a social planner, as usual when we formalize bailout. It's not a social planner who loves banks, okay? The social planner is just trying to rescue economic activity, and that's where the SMEs are important, because the SMEs are highly dependent on relationship banking, and therefore you may rescue those maybe willing to rescue those banks if they actually lend to small and medium enterprises. So you put weight 1 on consumer investors, weight 0 on banker, but you put weight beta on project completion and standard micro foundation. We have with Bank Tomstrom on that, which is such that it satisfies these inequalities. So what does it mean? What is a shortfall if you face a liquidity shock and you don't have any liquidity? You can always dilute your existing claim holders, and that will bring you at most rho 0, okay, which is the value of continuation for the investors. So by diluting, you can get rho 0, but you need 1. So your shortfall is 1 minus rho 0. And this condition says that the social planner attaches weight to completion, which is greater than the shadow cost of public funds times 1 minus rho 0. That means that in the good fiscal state, you'll be rescuing even the shadow banks. But that basically says that in the bad fiscal state, you will not be rescuing the shadow banks. Okay, and that's where you are going to need a lender of last resort if you want to rescue a bank, because you will not do it that voluntarily. And you can actually price at date 0 this lender of last resort function. Okay, so just to remind you, it's basically the timing. All the banks are ex ante the same anyway, so, and ex post they will be the same unless there is more hazard. The bank sets a tax, so you can try to actually subsidize retail banking to attract them and prevent them from migrating to the shadow sector, because there's always a possibility of migrating to the shadow banking sector. Or you can tax them, so you can ask them for money for lender of last resort, and later on when you introduce risk aversion of depositors for deposit insurance. Okay? The banks choose whether to be regulated or not, M equals 0 and M equals 1, and to opt in the lender of last resort scheme. and then there's supervision and so on, everything unfolds, okay? So just to give you some flavor for the complementarity, again, it's actually quite simple. You start with shadow banking. So in shadow banking, you can predict already that there won't be any more hazard in state B, which is a bad fiscal state, because you won't be rescued. So because you won't be rescued and you are eager to continue, there won't be any more hazard. But in the good state of nature, fiscal state, you'll be rescued, and then there is more hazard, okay? So what's going to happen is basically that if the banks go into the shadow banking sector, they will exert more hazard corresponding to the good fiscal state, because they will be bailed out, but not in the bad fiscal state. Now, the government can de facto, given there is no asymmetric information at date zero, can de facto choose which regime it wants to implement. It just has to find the right transfers. So just look at, so you have to choose a policy whether you want to monitor the bank, M equals 0, and whether L is whether you award them lender of last resort. So L equals 1 means that you're awarding lender of last resort, L equals 0, you are not. So here's the utility of a bank as a function of policy M, which is monitoring, and L, which is lender of last resort. U00 means that you're in the shadow banking sector. That's your utility when you're in the shadow banking sector, and I'm not writing what it is. I just want to write in differential terms. You will have to pay a transfer as a function of your choice. There will be a benefit from being monitored and a cost, because of course you will have to pay the cost of monitoring. But then there will be a benefit, which is that your depositors, your investors, won't have to be diluted, bailed in. I mean, the language of banking, they won't have to be bailed in, so they will keep their rho 0. 1 minus P, remember, is the probability of a good fiscal state, and delta is a reduction in the probability of liquidity in the good fiscal state. And same thing, you can do the same thing for L, which actually increase the probability for the banker to be able to continue and get benefit B. But the problem with provision of liquidity is then it creates more hazard for the banker, because the banker now is insured, and therefore is going to basically reduce the probability of illiquidity in the bad fiscal state, because he gets lender of last resort benefits. But the important term, forget about those ones. The important term is a cross-partial derivative, because there it basically tells you, M equals 1, L equals 1, you have a positive cross-partial derivative. So monitoring actually makes liquidity provision, lender of last resort function more desirable, because exactly what I told you earlier, which is that you end up with, monitoring reduces risk-taking, and therefore makes insurance cheaper here it's not for the government, it's actually for the firm, for the bank, because then they save the rho 0. So you can charge more to your investors at date 0. But you have the same thing actually, and again, it's important for social welfare. You get a cross-partial derivative, which is that in the bad safe nature, you eliminate more hazard, which is created by liquidity provision when you monitor, okay? And that has a benefit both for the investors and also for public funds. So the investors are not going to be bailed in anymore, so they gain rho 0, and a taxpayer is going to save capital lambda 1 minus rho 0, which is the liquidity it's going to bring to the firm after bail-ins, okay? So you get a cross-partial derivatives. That means that actually there's some kind of complementarity between lender of last resort and monitoring. I don't know where I stand in terms of time. Sorry. Okay, sorry, that's a soft budget constraint. Okay, so let me then what we do is to introduce what we call special depositors. I mean, basically, they are risk averse, and we formalize them in two ways. Actually, I never realized that. It's kind of interesting how you can, get different conclusions depending on the way you formalize special depositors. One is something that has been very popular since Jeremy Stein's 2012 paper. There are many, many papers who actually do that. Is you formalize special depositors as people who just want one, for sure. So they are willing to pay 1 plus theta, say they are willing to pay a premium, as long as they know that they get one at date one for sure. Okay, they want a perfectly safe asset. So having a safe asset, something which is quasi-safe with probability 99.9, they don't value that at all. But if they get 100% safe, they are willing to pay a premium. It's not a standard fund normal Morgenstern assumption, but that's the most common assumption nowadays to formalize special depositors. There is another way to do it, which is basically just say, like banks, we consumers, we may face liquidity shocks, a bit like Diamond Dewey in a sense, and it's more like a fundamental Morgenstern utility function in which you just may want to send your kids to college, or you may buy an apartment, or maybe it's fall sick, or you may go on a trip or something like that, and you really want to have the cash. But you are fundamental Morgenstern, and you may be interested in something which is quasi-safe, but not fully safe. Okay, in that case. But it's very different in terms of implication, in terms of studying, actually, of market equilibrium. For one thing, in the latter, you get spontaneous bailouts. So basically, the government is going to come in and rescue small depositors. By the way, it's not irrealistic. I mean, you see that with money market mutual funds. If they break the back, the government actually may come in and actually rescue, because the idea being it's a small depositors, and that may happen. It depends, and actually it's very interesting. There is an endogenous composition equilibrium, which is, let me just say a few words about this, is that if a financial product is purchased mainly by people who really need the cash, small depositors, then the government has an incentive to intervene and bail out the depositors. But then who benefits from that? Mainly the small depositors. So actually you can have self-fulfilling phenomenon that accrue due to the bailouts, which you never have in the first approach. So we deal with that. We have never seen the full treatment of that. It's actually quite interesting. And if some of you want to work on that, I think there is a fair amount of work to be done, because we don't fully understand all the implications of that. Okay, but in terms of the idea, it's kind of straightforward, because it's exactly the same thing as lending of last resort, which is you ask yourself, it's costly to provide deposit insurance, especially in the state of nature in which a shadow cost of public funds is pretty high, right? And that's the first observation. The second observation is that you want to actually not give deposit insurance. You don't want to have entirely public insurance. You also want to piggyback on the pledgeable income row zero of the banks, at least in the state of nature in which they don't face a liquidity shock. So you just don't want to create a public institution which is going to basically pay all the deposits, all the depositors. You want to pay contingent on the banks being illiquid. As long as they are liquid, you want the money to come from the banks. Okay, and monitoring allows you to reduce the cost of deposit insurance. Okay, and again, there is complementarity between monitoring and deposit insurance. So it's exactly the same reasoning, but with a number of interesting twists, actually, as for lending of last resort. So again, lending of last resort, you insure the bankers. Deposit insurance, you insure their clients. Okay? So let me skip that because it's going to take too much time. And so, shoot. So the last part of the paper, and it's a very long paper, so it's just some kind of advertising of the paper, I'm afraid. But the last part of the paper is getting at cross-exposure. So in the first part of the paper, there is no way of talking about cross-exposures because liquidity shocks were perfectly correlated. So there was no reason to have any line of credit from one bank to another, for example, one financial institution to another. So if you want to have those kind of phenomenon, you have to introduce imperfect correlation. You cannot just have perfect correlation. There's no liquidity pooling so far. So we introduce imperfectly correlated shocks, and if one bank suffers a shock while another doesn't, then you could have cross-insurance between the two. Okay? But there are two hazards. One is what we call bogus liquidity. So basically, you secure funds from other institutions actually that are going to go bankrupt when you need the funds. That's what we call the AIG syndrome. So the AIG syndrome, remember, is that a number of banks and insurance companies actually were getting CDS insurance from AIG. And of course, when AIG went bankrupt, the insurance was not there anymore. So it's kind of insurance that you have for your prudential regulation. You claim you have insurance, but you don't have it. Okay? That's the AIG syndrome. The other one I already mentioned is that you may actually have this lender of last resort liquidity siphoned off to shadow banking. And remember, the conduits actually created by the bank for securitization purposes were getting lines of credit in case they could not roll over their short-term debt. And that was a big risk, actually, for the retail banks. So that's what we formalized thereafter. And we have a model which is very quickly, which is a generalization of the basic model. Take rho 0 equals 0. There's no pledgeable income for simplicity, no special deposit. It doesn't matter. But it's a generalization. So think about each bank at date 1 receiving 1 or 0 as an income. And it has a reinvestment need 1 or 0 as well. There are so for a given bank, there are 4 possible state of nature. So here is the revenue and here is the need, for example. Here is a bank, this one is a bank which in that state of nature has no revenue and has a liquidity need 1. So basically it's what I called earlier an illiquid bank. Here is a bank which has, those are 2 banks which are kind of balanced. They have no liquidity need. And this is one which has no liquidity need, actually has excess liquidity, right? It has a revenue and no bank. So you like the banks which are in this state of nature actually to insure those banks which are in that state of nature. There's a natural insurance mechanism. And you might get, one, you can give a line of credit to the other, for example. Or you can give some kind of swap or some kind of CDS or whatever. There are many vehicles for cross insurance, but they all create cross exposures. Now, that never occurred. That possibility never occurred because you never had a state of nature in which one had excess liquidity and the other one didn't in the previous model. So, so what we do is actually let me just, this way, there's something missing. Okay, I think there's something missing. No, yeah, well, I must have forgotten the slide then. So it's a generalization, so the previous case was a special case. There's a case where there is no liquidity, a state of nature where there is no liquidity and all get 0, 0. Then there's a spread of widespread illiquidity in which they all have revenue 0 and need 1. Okay, so those are the 2 states we had before. And then there is a third state where there is an insurance opportunity. They are not perfectly correlated. And some have a shortage of liquidity, some have an excess liquidity. So overall, there's enough liquidity in the economy. But for that, you need to have cross-insurance across banks. Okay? And that new state has probability pi, in previous model pi was equal to 0. So basically, I can write insurance contract with you in that state of nature, and the other states were correlated, so it doesn't matter. We cannot do that, but in that state of nature, we can write a cross insurance contract. But we have to match in the right way. We have to match in the right way so that when I'm illiquid, you are liquid. When you are liquid, I'm illiquid, and you understand me. And we can actually, it's just an insurance contract, right? Okay, but of course we can game the system. So if we know our type, if we know our correlation structure, but the regulator doesn't, then there's a problem, because we can make sure that when you are liquid, I'm also liquid, and I'm basically an empty shell. I'm not giving you the money that you wanted to have. That kind of a gaming, you can choose and game the system and increase risk and increase the put on taxpayer money. So basically, we make two arguments, and again, I'm going to go very fast. The first argument is that by definition, you don't regulate the shadow banking sector. So there's no way of knowing the correlation structures through joint stress test between the shadow banking sector and the retail banking sector. So if you start having cross-insurance between the two, you are going to get situations like AIG, where basically your retail bank will claim bogus liquidity they don't really have, because you cannot check what's going on with the shadow banking sector. And that provides a rationale for ring fencing. The second argument is that even within the retail banking sector, you may get into trouble if you are not able to do the right joint stress test. If it's too difficult to know exactly the correlation structure, then you can reselect, in a sense. So each bank can reselect and basically make sure to maximize the put on taxpayer money. And that's where a second argument comes in favor of exchanges. And perhaps it's a new argument. When you get insurance through an exchange, you don't reselect, you don't choose your partner. And whereas if you are in bilateral deals, which is a standard way of doing things, then you can reselect and game the system. Okay, whereas an exchange, there is no information that you have that the regulator doesn't have about the correlation structure. So it's an argument in favor of exchanges over the-counter trading. So, so basically, let me go a little bit through that and just conclude. So there are lots of things to do, but our thing was mainly a normative thing. Basically, find that those 6 features were aligned, in a sense. There is some kind of logic of aligning those 6 features: lending to small and medium enterprises, taking retail deposit, getting deposit insurance, getting access to lender of last resort function, being monitored, ring fencing, and use of exchanges. Okay, there are lots of things which are actually very important to study, whether private sector or the government has some competitive advantage in supervising. We were completely neutral in the paper. We just assumed that was the same cost. In general, that's not going to be true. There's always a question which is very important in regulation, which is, why don't we bail out the bank? Why do we bail out the bank rather than the counterparties when there is a bailout? So that's it's always a very difficult issue. Why do you bail out AIG? I mean, you might just say, let's bail out the counterparties. And of course, asymmetric information is crucial for that. Universal banks. So I talk about ring fencing between shadow banks, which are unregulated, and retail banks. But that doesn't talk to multiple lines of activities, because universal banks, They are both in retail banking and investment banking, but they are regulated. Even the investment bank part is regulated. So there are actually many, and there are many other questions, but I think we need to understand shadow banking much better. It's growing. It's always going to be there. The migration issues, you have seen that in many episodes. Anytime you try to actually make regulation tougher, which probably we should do, given what has happened in 2008, you are quite sure that this activity is going to move slowly towards shadow banking. And there's no way you can regulate the entire system, because you don't know what a shadow bank is, fundamentally. And you have to think about this migration. You have to think about how you deal with all those regulatory issues, and we need to understand much, much better all those issues. Okay. So summing up, I've already said the cardiology and the migration, and controlling for bank exposures. But let me stop here. Thank you. I think no, Felipe, we have time. I don't have a watch. Yes.
Yes, I mean, very long presentation. My take away is a complementarity between the lender of last resort and regulation, but it's based on the premise that regulation can eliminate moral hazard. And it seems to me, maybe you can tell us that in the case, for example, of EAG was the opposite, that the regulation made the moral hazard from the EAG point of view increase, because they knew that at the end, because they are widespread, something is going to happen. So that is my first question: how do you see not at the banking level, but at the EAG level, if the same mechanism works? And the second question is more science fiction. With blockchain technologies and fintech, it seems that we're moving more towards shadow banking. What is your view of that?
Okay, so two questions. The first is whether AIG, actually the regulation could actually increase more hazard, but in a sense what you are saying is consistent with what I said, which is if you don't have ring fencing, then there's a possibility of having to rescue AIG because you want actually to rescue the retail banks and the insurance companies. So at that point, it's a different argument. Regulation actually, we assume, it's just an assumption that regulation reduces risk. It's a reasonable assumption, I think, reduces risk in retail banks. But if you have no ring fences, it might increase actually more hazard in shadow banks. And that's so what you are saying is completely consistent with what I was saying. Now about blockchain, okay, you want to get me going on fintech. So the thing is that, again, there's actually this question about this tension. People view fintech as being a great thing because it's some kind of breathing space. Not so much because of regulation, but it's basically because the incumbents are, as usual, slow in innovating. The adoption of new technology is faster in the shadow banking sector. At the same time, I'm very concerned about some of the evolution. So take about debt lending or equity lending. Say debt lending, for example. Crowdsourcing using debt instruments. My guess is that there will be some very big scandals. Because, unless what's being lent is like AAA corporate securities, and then there is no big issues. But by definition, there's a lot of lending which goes through to small enterprises, on which there is very asymmetric information. And actually, you see now the fintech company, actually they become more and more like intermediaries. Okay, they are like a bank now, more and more. Actually, it's no longer crowdsourcing anymore. They basically channel your savings to some kind of thing. So they become like banks, except they don't have equity of their own. So it's kind of strange in a world in which we are trying to push toward tougher regulation. Actually, that people like you and me are putting their money into things which are intermediated but have no equity at all. And it's scary if you think about it. Now, it's still on a small scale, but coming back to this issue about special depositors, one of the things that may happen is that if it grows in importance and small depositors actually invest in that kind of thing, and there are big scandals, you know, with the borrowers defaulting, then there might be some strong pressure on the government actually to intervene and bail out the depositors themselves. And that's really a concern, because technology is one thing. It's wonderful to have a new technology. We should adopt it, of course, and so on and so forth. That's wonderful. But it's another thing, the fundamentals of intermediation remain. You know, the asymmetric information, the dedicated monitoring stuff, and so on, that remains, and that's there to stay. And we should not forget that it's not because you do it on your mobile phone, it doesn't change the fundamental, right? I think we're done. Okay, thank you very much for being here. Thanks, Felipe.